Hello, viewers. My name is Adebayo Olumuyiwa. I'll be discussing with you today on accounting policies, estimates, and errors. All of our discussions will be in accordance with International Financial Reporting Standard as issued by the International Accounting Standard Board, IASB. IAS 8 is applied in selecting and applying accounting policies, accounting for changes in estimates, and reflecting corrections of prior period errors. And I'll put a code to us, which is a traditional code, where we were told that old accountants never die. Rather, they simply loses their balance. They just on a softer mode. Now, all what we'll be discussing today borders on policies that underlines the preparation of financial statements and equally the presentation of financial statements. Now, it is key for us to have better understanding of accounting policies based on its purpose, based on who is responsible for setting accounting policy, and what happens where there's a need to change an accounting policy, and how often can accounting policies be subjected to changes, and what will warrant such change, and of what effects would the change in an accounting policy be to the financial statement of an entity. All of this will be considered in the course of this lecture. Furthermore, we'll more or less discuss on accounting estimates, which is a bedrock for measurement in accounting, and which also allows us to comply with the requirements of conceptual framework and also assist us in fulfilling the rule that borders on accrual basis of accounting. And in looking at that, we'll look at the role estimate plays in the financial statement. We'll look at situations whereby estimates might require changes and also changes have to be reflected in the financial statement. As we also move on, we'll look at situations whereby it may not be clear for an entity to identify whether changes that has occurred might be attributed to accounting policies or rather accounting estimates. As we also move on in the course of this discussion, we'll also review material errors that may have occurred in prior period financial statements which were not observed or detected in those periods, of which they were detected in the current period, and how should such changes be reflected in the current period financial statements, and of what consequence would that be with respect to disclosures. All of these are what we are going to discuss in this video. And we believe that this discussion will assist not only professionals on the field, it equally assists academicians in order to pass the message and more or less impart that knowledge to students. It also assists professional students undergoing professional accounting courses, probably for ICANN, ACCA, CIMA, and etc. Also, it will be worthwhile for students in tertiary institutions to also keep themselves abreast of this fundamental practical application. And all what we'll be discussing today is with respect to the practical application of accounting policies, accounting estimates, and correction of prior period errors. Now, as we move on, we'll be looking at the objective of IAS 8 as defined by the International Accounting Standard Board. The objective of IAS 8 is much to prescribe the criteria for selection and possible changes in accounting policies, together with how such changes may be required to be treated in the financial statements, vis-a-vis changes that will occur in the course of making an estimate in the accounts, and finally on how prior period errors considered to be material should be corrected in the current period financial statements. And this is a summary of the objective of IAS 8. But before going deep into discussion, there are some terminologies that we are likely to come across and which we need to appreciate. And the first one is, what do we consider an accounting policy in its totality? When we talk about accounting policies, we are more or less talking about the totality of accounting principles. We are talking about set of rules. We are talking about guidance in accounting. We are talking about conventions. We are talking about practices in which are considered acceptable, all in a bid to preparing and presenting financial statements. And that's why an accounting policy from the framework and also from the standard is defined as the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. And that is key for us to have at the back of our mind. And in literal meaning, what we simply say is that every policy serves as a guide towards an end, which means they are more or less like a means to an end. Where you have a policy, it means the policy will give you a guideline to which what you need to do is achieved. Therefore, that same principle or ideology can be applied to accounting, which is what we have just mentioned. Furthermore, we also ask ourselves a simple question. When we talk about changing an accounting estimate, what do we refer to? First, we need to understand that an estimate is just a measure of value. That is a way of ascribing value, depending when the actual value of such transaction, event, or condition come into existence. In a simple way, I could say, if I am required to provide for doubtful debt, and I believe that out of a debt of 100 million naira, 10 million naira is considered non recoverable. For me to consider 10 million naira non recoverable, it means I have a basis to which such estimation is made, and which implies that 10 million becomes an estimate, which is a measure of value, depending when in the immediate future the amount so recovered will determine the actual amount of our bad debts. And that's what we're talking about. Which then implies that there might be difference between the amount so estimated as irrecoverable and the actual amount that is lost as a result of the debt going bad. Therefore, we can say a change in accounting estimate is an adjustment to the carrying amount of an asset or a liability, or in some situation, it is an amount of the periodic consumption of an asset that results from assessment of our present status and our expected future benefits. And likewise, it could be attributed to obligations associated within an asset and liabilities. And that's just a brief description of what we term a change in accounting estimates. As we move on, we also try to look at what do we consider international financial reporting standard. International financial reporting standard, based on the requirements of the conceptual framework, can simply be characterized by the following. It's made up of standards and interpretations. Standards can be viewed from two perspectives. The first perspective are number series standards labeled IFRS. And at present, we have such from IFRS 1 to IFRS 16. The latest one being IFRS 16 borders on accounting for leases. Likewise, we have the old nomenclature, which is numbered IAS 1, and up to date, it has been issued up to 41, even though most standard within the nomenclature IAS has since been withdrawn, while some has been reviewed to keep into term the principle-based requirements of financial reporting system of the International Accounting Standard Board. Now, also, set of interpretations include those that were issued subsequent to the transformation from International Accounting Standard Committee to International Accounting Standard Board far back 2000, where new interpretations issued and numbered IFRS. That means we are talking about IFRS interpretations. And likewise, the old nomenclature stands as the Statement of Interpretation Committee, which in short term we call 6. And therefore, we could conclude that when we talk about International Financial Reporting Standards, we are simply talking about standards numbered IFRS and IAS. And likewise, we are talking about interpretations numbered IFRS and 6. Also, we'll be looking at what we consider material to the financial statements. Materiality in terms of threshold does not have international definition. Simply put, materiality can be considered only from entity-specific point of view, which we can simply put as what could be material to entity A is not likely to be material to entity B, which means situation, circumstances, position, value, and other things are to be taken into consideration at every point in time, which then implies that materiality should always be considered at an entity's level. Now, in simple terms or in a descriptive nature, materiality can be perceived as what will have influenced your decision, either way, given its existence, its omission, or misstatement. What I'm trying to say is this: if my decisions will have been influenced by having that information, it then means that such information may be considered material, which means decision A will have been taken if such information has not been available, or decision A was taken because information is available, and likewise if such information has not been available, decision B would have been considered. Therefore, regardless of the size, the magnitude, the relative analysis of such, it will be considered material, which means materiality is not limited by size, events, or nature of what has happened. And that's why we can consider that omission or misstatement are material if they could individually or collectively influence the economic decisions that users of financial statements make on the basis of the financial information. Also, we'll be talking about prior period errors. Now, errors in general are considered misstatements attributable to omissions, confusions, intentional misrepresentation, and etc. And therefore, these have to be corrected in the financial statements. Now, the errors we are considering here are not necessarily errors that occurred in the current period, or because once it occurs in the current period and you observe such error, what is required of you is to correct for it immediately. But we are looking at errors that by oversight or otherwise were not observed or discovered in the prior period. And by so doing, the entity will be forced to correct for those errors in the current period. And later on, we will have to appreciate the way and the modalities to which such errors are required to be corrected. And that probably will lead us to what we call retrospective application. When we talk about retrospective application, we are simply talking about a situation where new policy that has been adopted as a result of moving from one method to another will be required to be applied as if that policy has always been in existence and used by the entity in the time past. And when we get to the changes in accounting policies and its effects and accounting, will better explain what we mean by retrospective application. Also, we'll be talking about retrospective restatements. This is usually associated with errors when it is required to be corrected in the current period financial statements, which implies that every line item within a financial statement is required to be corrected, adjusted for on a line by line basis whenever such error has been discovered. And therefore, retrospective statement can be seen as a correction that will impart recognition, measurement, disclosure of elements contained in the financial statement. And if you remember, the elements of financial statements include the assets, the liabilities, the equity of the entity, the income, and the expenses. Also, we'll be looking at prospective application. In simple terms, prospective application can be defined as a situation where any adjustment required as a result of changes in a measurement basis have to be reflected in the period to which such information regarding the change occurs. And in such situation, such adjustment affect that period. And in some instances, we might find ourselves having to adjust not only the current period, but likewise the adjustment can impact future periods, but not prior periods, or what we term past periods. Part of what we'll be discussing is how practicable certain things will be in the course of adjusting the financial statement. Now, this is usually attributable to retrospective application and probably restatements of our financial statements. What it simply means is that when we talk about retrospective application, which we have mentioned earlier, it focuses much more on adjusting the past, probably from the initial point in which such transactions was recognized or when the event occurred. And therefore, it could imply us going far back as 10 years, but the issue there borders on how practicable it is to revisit activities 10 years ago, which might be limited by the resources required, availability of data, the cost outweighing the benefits, the materiality of the adjustment, and etc. All of this is what determines the practicability of retrospective application. But in simple terms, the standard considers situation whereby such might not be feasible, which then implies that you can only retrospectively apply changes in accounting policies provided it is practicable. And that's why applying the requirement is impracticable when the entity cannot apply it after making every reasonable effort to do so. And therefore, for a particular prior period, it can be considered impracticable to apply a change in accounting policy retrospectively or make a retrospective statement to correct an error if the following exists. 1. The effect of retrospective application or restatements are not determinable because of availability of data. The retrospective application or restatement requires assumption about what management intent will have been in that period, which may not be feasible, or a situation where the retrospective application or restatement requires significant estimates of an amount and it is impossible to distinguish objectively such information about those estimates that one could provide evidence of circumstances that existed on the date, as at which those amounts are to be recognized, measured, or disclosed in the financial statement. And likewise, too, would have been available when the financial statement for that prior period were authorized for issue from other information, which means impracticability of retrospective application depends on those things I've mentioned earlier. What will it cost the entity to retrospectively apply it as far back as 10 years or more? Are data available to support relevant assertions towards reflecting such changes in the financial statements? Will the cost not outweigh the benefits of doing so? And some other things. These are literary factors that may limit an entity from retrospective application. But later on, we'll find out in the standard that in practice, we retrospectively apply such changes as far as it is practicable. This is equally supported by the requirement of the standard. We are going to come across this at a later time. Now, we'll be moving towards a critical aspect of this discussion, which borders on what modality applies in the selection of accounting policies, which means how is an accounting policy of an entity determined. First, we need to understand whose responsibility is to determine or approve the accounting policy to be adopted by an entity. First, we need to understand that the accounting policy to adopted is just not a mere accounting exercise. Rather, it needs to synchronize to the corporate objective or serve as one of the tools towards achieving corporate objective in terms of financial reporting. Okay, and therefore, when we look at corporate objective, there are strategic decisions that need to be made by the company towards achieving a set objective. And we ask ourselves a simple question based on corporate governance. What body or what group within an entity is responsible for the corporate governance of an entity or responsible for the strategic business objective of the entity? And in simple terms, we'll reach a conclusion and say it is the responsibility of the board. Hence, the same board will be responsible for approving the accounting policy of an entity, even though the board may require the input of management, or the board has the full responsibility towards approving the accounting policy. And that's what we need to first of all understand. And therefore, in setting an accounting policy, the board needs to look out for the long-term strategic goal of the entity in setting a policy, or because the policy so adopted should be in tandem with the business model and business objective of the organization. And therefore, it may not be more or less acceptable, or it may be unlikely that in the immediate future, changes of such policies may be more or less considered appropriate. And that's why it is key for organizations to know that when formulating policies, long-term corporate goal and objective should be the basis to which those policies are formulated and adopted. Now, it is very key to know that the sources of formulating an accounting policy include the standard. The standard gives latitude to which alternative measure exists for the purpose of recognition, measurement, and disclosure of information within the financial statement, which then implies that an accounting policy is to be adopted from the alternatives provided by the standard. And it then implies that when an IFRS specifically applies to a transaction, event, or conditions, the accounting policy or policies applied to that item are determined by applying the relevant IFRS, which implies that a policy regarding a method of recognition or measurement cannot be selected outside what the standard has provided. Okay, and that's what we're trying to discuss. And also, it may not be necessary to apply these policies if the effect of applying them may be immaterial, or because we have said it severally from the angle of the conceptual framework that materiality represents the key word for applying accounting treatment strictly. But that doesn't mean that items that are considered non-material may not be required to be accounted for as deemed appropriate. Okay, but situations will exist at some time where dynamics of transactions might be such that they are evolving and they might not have a specific standard that more or less apply to them, which implies that where IFRS does not specifically provide guidance or provide method or alternatives towards measurement, recognition, or disclosure, it will be evidence that certain steps need to be taken. But in taking those steps, it is paramount that we know that any policy you adopt outside IFRS, or because the standard does not have specific requirements or method that should be adopted. Therefore, any other consideration that has been more or less adopted by the board should take into cognizance the following attributes. 1. The policy so adopted outside the standard should be considered relevant to the economic decision-making needs of the users of financial statements. Such policy adopted should be considered reliable to the effects of transactions, events, and conditions in the financial statements. Such policy should be a representative of what actually transpires within a financial year, which means it must reflect the economic substance of transactions, other events, conditions, and not merely the legal form. Such policy should represent faithfully the financial position, financial performance, and the cash flow of the entity at every point in time. Such policy should be considered conservative or prudent in nature. Such policies should be free from biases and considered neutral in all respects. And such policy should allow the completeness of the financial statements. But there is a chronological order to which policies may be adopted in the advent where IFRS does not specifically address a particular transaction, other events, or conditions. The first thing you need to consider is to consider whether similar standard or other standard within IFRS addresses similar transactions, which implies that if there are similar transactions to that particular transaction and a particular IFRS addresses such transaction, therefore it may be appropriate to adopt the standard temporarily in more or less formulating our accounting policy towards the recognition, measurement, and disclosure of such dynamic transaction. And if similar transactions do not exist for such transaction, it will be appropriate for us to resort to the conceptual framework of IFRS as issued by the International Accounting Standard Board. And we'll more or less make use of the recognition criteria and the measurement criteria of the element of financial statements as depicted in the conceptual framework. And we adopt this as a guidance towards formulating an appropriate policy for such transactions and events. And where conceptual framework might not aid the necessary recognition and measurement of such transaction, it will be best for us to seek for other standards that are acceptable to our specific situation. And those standards will be considered to have a similar framework with the framework of the IESB, which we call the conceptual framework, which means the conceptual framework to which that standard is developed should be similar to that of IFRS. For example, US GAAP might be a better surrogate for IFRS, where certain transactions are not specifically addressed by IFRS. And in that situation, it may be appropriate for us to adopt US GAAP that specifically address such transactions as a basis of formulating our accounting policy. And where such do not exist, or probably put, where US GAAP also has not been able to address such transactions, we need to fall back on what are the accounting theories or literatures that more or less addresses those transactions, which then implies that there might be some literature or research that has been conducted by accounting practitioners that tends to address such peculiar situation where certain propositions may have been made in terms of method to be adopted for such transactions. And if that do exist, it will serve as a basis to which we can formulate an accounting policy. But if we have no such accounting literatures, therefore it will be best for us to look into the industry and try to observe what are the industry acceptable best practices toward recognizing this particular transaction. And therefore, if there are industry practices, it will be appropriate for us to adopt that as a basis towards formulating the accounting policy. And that represents the chronological order to which an accounting policy is formulated. Okay, we'll be looking at a practical scenario. This will be the first scenario that we need to go through in order to have a better appreciation of what we have discussed so far. Now, the scenario borders on selection of accounting policy for combinations of entities under common control. And the simple question borders on whether a statement of prior period information, which we call the comparative information, is necessary. Now, the illustration goes thus. There are two entities that tends to be a subsidiary of Bali. The two entities are Susie and Shisha, and following a decision by the parent, which is Pali, there is a need to reorganize the legal structure. And the legal structure is such that parent, which is a Pali, acquires Susie and Shisha. And neither Susie or Shisha have stake in one another. And in this situation, it is deemed that parent, which is Pali, have decided to more or less sell a subsidiary to the other subsidiary in order to change the legal structure of the group. And in this case, the acquisition of Shisha by Susie is considered a combination of entities under common control, not because both are under the same control. And this is excluded from the requirement of IFRS 3, which implies that there is no policy existing within the framework of IFRS for group restructuring or reorganization that is termed an acquisition under common control. And the question then is, how should Susie account for such acquisition in its book, given that the acquisition is from his parents? And that's what we are trying to look at here. Since there's no accounting policy that can be drawn from IFRS, what then can we do? The first thing, as we have said earlier, is to revisit whether similar transaction exists that has a particular standard that addresses such situation. But in this case, none exist. Second thing we ask ourselves is that, do we have a conceptual framework that necessarily give us guidance to this? The answer is no. The third is, can we look for a standard that is not IFRS that shares similar conceptual framework? And what will easily come to my mind is the US GAAP. Now, US GAAP have more or less methods that tends to address such situation. And in that case, it will be appropriate for Susie to adopt such. And such method is similar to the pooling of interest, or what we call the merger accounting we have sometimes in the past, when we have IS 22 as the standard for business combination accounting, before it was repealed in 2002, a subsequent issue of IFRS 3 in 2003. Okay, now the question we put to ourselves is this: since we have adopted US GAAP for this particular transaction, is Susie obliged to restate the comparative periods in its consolidated financial statement as if Susie had acquired Shisha at the beginning of the earliest period presented? And these are the suggestions that have been made. Now, the first one is, it may be unlikely that SUSI will restate the comparative period of its consolidated financial statements. Even if SUSI has developed its accounting policy by reference to the pronouncement of another standard setting board that requires a statement of comparative figure when such method has been used, SUSI is not bound to apply all of the requirements of such pronouncements other than IFRS. However, the decision usefulness of the restated comparative information should be considered by management when developing its accounting policy. And if the failure of such restated comparative information will be detrimental to the users, it then implies that it will be appropriate for management to restate. And finally, SUSI should consider local requirements, and where your local requirements, such as CAMA, specifically requires restatements of comparative information for such situation. Therefore, it may be appropriate to do so. And this just demonstrates the situation entities may find themselves when there's a need to formulate an accounting policy or transaction that does not specifically have IFRS as a guide. Now we'll move further to the principle of consistency when we talk about application of accounting policy. Now, when a method of accounting has been adopted, for example, if FIFO has been the method for inventory valuation or costing techniques for inventory, this is expected to be used in the near future as a method for accounting for the inventory, except in extreme situation when such change will be deemed necessary. In simple terms, what we are simply saying is that consistency is a watchword when it comes to adoption and application of accounting policy, which means any accounting policy so chosen should be constantly applied by the entity, okay, except where situation may warrant a change. And we are going to consider this as we move forward. Now, accounting policy should be applied constantly to similar transactions, other events and conditions, unless an IFRS specifically requires or permits the categorization of items for which different policies may be appropriate. If this is the case, an appropriate accounting policy should be selected and applied consistently to each category. Now, changes in accounting policy, we need to evaluate it as we move on. The first evaluation is we need to look at circumstances in which a change in accounting policy may be permitted. As we said earlier, any policy adopted should be constantly applied. But the question is, what if there is a need to change? We need to now evaluate what are the circumstances to which a change in accounting policy is deemed appropriate and permissible by IFRS. The first one we need to look at is a new standard issued or an existing standard revised may change the methodology or principles to which transactions are accounted for, and it is mandatory to move in that direction or to embrace such change, and therefore it means such changes are considered involuntary or mandatory changes. Furthermore, the change might be necessitated by the fact that the entity more or less consider that the new method will be more appropriate to reflect the true financial performance, financial position and not the cash flow of the entity at that particular period in time. Which then means that such change is considered voluntary change. Voluntary change because embracing such new method will better reflect the financial position, the financial performance, and the cash flow of the entity. Now, there's a technical note we need to consider. The first one is it is important that changes in accounting policy are only made if at least one of the criteria specified above or earlier discussed are met. Otherwise, comparability over time within the financial statement may have been lost to such changes. And secondly, one consequence of the requirement of IS 8 is that if a policy is changed in 1 year, it is unlikely to be justifiable to change it back in the immediate period. And these are to the original policy in a subsequent year. Similarly, it will be difficult to justify the adoption of a policy when it is known that the policy will be changed again in subsequent year because of a new standard or an interpretation in issue, but not yet effective as at the date of its first change. This, in summary, assists to depict situations that support changes in an accounting policy. Okay, we'll move on. Let's look at practical scenario 2. Now, this borders on voluntary change. Now, in this scenario, Arsenal PLC has applied IFRS for a number of years. Prior to its 2015 reporting period, Arsenal's policy was to account for all of its investment property using the cost model as permitted by IAS 40. Most of other participants in Arsenal's business sector applied the alternative model permitted under IAS 40, which is the fair value model. In 2015, because of this prevalence, Arsenal decided to change the accounting policy for all investment property to the fair value model on the basis that this model will provide reliable and more relevant information for the users of its financial statements. Now, we need to consider this and ask ourselves a simple question. Such changes can it be termed a change in accounting policy? And secondly, if it's a change in accounting policy, can we deem such change to be appropriate to the business of Arsenal? Now, the first thing we need to look at is this. This is a change in accounting policy, or because investment property still retain its class, its use still remain the same, which means circumstances have not changed, but rather what changed is the basis of the measurement of such investment property from cost model to fair value model, which then implies that this is a change in accounting policy. Also, this change is necessitated by the fact that Arsenal intend to reflect a financial position and financial performance that is comparable to its peers and which more or less make it acceptable change to the users of financial statements. Okay, and that's what we need to observe in this situation. Now, furthermore, we'll now look at a situation where applying new accounting policy following a change in circumstances. What it simply means is, can we consider a change in methodology or a change in principle towards recognition and measurement as being a change in accounting policy when in fact circumstances has changed which necessitated the change in methodology? And in doing that, we need to look at this scenario. The scenario borders on the use of property. GEJ owns an office building that in previous reporting period has been classified as items of property, plant and equipment, or because its owner occupied. And this has been accounted for as cost model under IAS 16. But during the reporting period, JJ probably moved location, that is, moved the administrative function from that particular property to another property. And by so doing, JJ decided to change the usage of the initial property from administrative use to what could likely generate rentals and capital appreciation if necessary, which means JEJ has vacated the property and it has since leased the property to a third party. JEJ's accounting policy for investment property is to adopt the fair value model. Now, the simple question we ask in this case is that can we consider the change in the method of cost to fair value on that particular property to be a change in accounting policy? But when you look at it, the simple question is, are the circumstances to which the usage of that property has it changed? In this case, it has, because the property no longer belongs to the class of property, plant and equipment under IAS 16. It now belongs to a class of investment property under IAS 40, which then implies that the policy of JEJ for investment property, which is a separate class from property, plant and equipment, has always been fair value. And in that situation, the property, based on its usage now, has made it change or transform from item of PPE to items of investment property. And by so doing, this will be the first time the fair value model is used for that particular asset, which implies that that asset in its current form as an investment property is measured for the first time at fair value, or because it's no longer the property that is considered owner occupied or the administrative property, which falls under IAS 16. And that's why it is unlikely that this will be considered a change in an accounting policy. Rather, the change in accounting treatment or method has arisen because of a change in circumstances rather than a change in accounting policy. JJ's policy for each type of property remains unchanged, but the office building in question is accounted for as an investment property from the date of the change of its usage. No retrospective restatement should be made in these circumstances because it is much more attributed to change in accounting estimate rather than a change in an accounting policy. Also, we move further to look at application of new IFRS in advance of its effective dates. Now, is it practicable or is it permitted for an entity to more or less early adopt an accounting standard that will be effective at a subsequent date? The position of the standard is so clear. Any standard that is newly issued and of which early adoption will be permitted will be expressly stated in the standard. And in that situation, it will be acceptable and appropriate for an entity to early adopt such standard, and disclosure relevant to such application will be required with or without early adoption of the standard. We will consider a particular illustration that depicts. Okay, we look at this illustration. FARA reporting period ended 31st December 2015 and has since applied IFRS for several years. On the 24th of January 2016, a new standard was issued by International Accounting Standard Board, of which the effective date of the standard would be an annual period that begins on or after 1st of January 2017, and of which early application is considered to be permitted. FARA PLC will not issue its 2015 statement until 1st of March 2016, which implies that 1st of March 2016 is the date in which the financial statements of FARA will be considered or deemed to have been authorized for issue. In simple language, the date in which the financial statement is approved. Now, the question put to us is this: is FARA PLC permitted to apply this new standard issued after its own reporting date, but prior to when the financial statement is issued? And the question is this: a financial statement is prepared as at 31st December 2015, and sometime in January 2016, the period in which financial statement is still being prepared, examined, reviewed prior to its authorization, new standard came into existence. As such, new standard require early adoption when necessary. And the question then is, will it be appropriate for us to have adopted a new standard that was issued on the 24th of January 2016 and apply it to a financial statement reported as at 31st of December 2015? And the simple answer is broken down as follows. It is likely that the company is permitted to apply the new standard. Why? This is because the new standard allows for early application, and FARA has the option to apply the new standard for the periods in respect of which financial statements have not yet been issued. If the new standard did not allow application in advance of its effective dates, therefore we can consider it inappropriate. Also, FARA may not adopt exposure drafts or other guidance that has not been issued in its final form. Okay, which is very key because it might likely change at the point of issuing the standard. Furthermore, early application of IFRS is not a voluntary change in accounting policy. Rather, any specific transition provisions in the new standard is required to be applied by FARA in its financial statements as at 31st December 2015. And in summary, if the entity decides not to apply the standard in advance, it will be appropriate to disclose such situation in accordance with the requirements of IAS 8. Technical note applies in this case that when an entity has not applied a new IFRS that has been issued but yet to be effective, the entity will be required to disclose the facts that such standard has not been adopted in advance. And two, known or reasonable estimate of information, or simply put, estimable information relevant to assessing the possible impact that application of the new IFRS will have on the entity's financial statements in the period of its initial application, which means if it is probable that you can more or less quantify and qualify the potential effects of applying that standard in the future. Therefore, it will be more or less appropriate to disclose such facts. And where such cannot be done, you are equally required to disclose such facts in the financial statement. Also, we'll be looking at the initial application of a policy to revalue assets in accordance with IAS 16 and IAS 38. Now, this is an exception to the rule, okay? An exception to the rule, which we are going to explain in, in a short while. Now, what am I talking about? That initially we discussed the fact that when you change an accounting policy, it is required that such change should be retrospectively applied. Retrospective application entails you applying the new method or policy as if that policy has always been in existence from the time past, which implies that you have to adjust the financial statement to reflect the cumulative effect of applying the new policy from the initial point at which the transaction is recognized or the event occurred. Now, the initial application of the policy to revalue assets in accordance with IAS 16 or IAS 38 is a change in accounting policy to be dealt with in the revaluation model of IAS 16 or IAS 38 rather than applying the principle of retrospective application under IAS 8. What this simply means is that if cost model has always been your method for accounting for PPE or intangible assets, and you decided in 2017 to change your basis of recognition from cost model to fair value to revaluation model under IAS 16 for the property, it then implies that you will not be required to retrospectively apply the change in accordance with the requirement of IAS 8. Rather, you have to comply with the requirement of IAS 16 such that you apply the change in the period to which such change of method occurs, which means in 2017 it will be deemed that you revalued your assets, and the effect of that evaluation is accounted for in 2017, and also the effect will likely affect future periods with respect to depreciation of such asset or amortization where necessary. This is a general exception to the principle and the rule of IAS 8, and which is very clear in that situation. Okay, now we'll move further to evaluate what will be the impact of the change in accounting policy. Now, when you change an accounting policy, it is required that you retrospectively apply the new policy, which then implies that adjustment may be necessary to the financial statement in the current period, having adjusted the cumulative effects in the earliest period or date in which the financial statement is presented. Now, what that means is this: when you change your method from FIFO to weighted average in 2017, and you tend to use the financial statement of 2017, what then applies is simply you apply the new method to the earliest period to which the transaction occurs. Let's say the last inventory count occurs sometimes in 2015, where you have inventory, and let me say in 2014 you close with no inventory, which means the only time you start to record inventory item was 2015. And equally, you had inventory in 2016 prior to the beginning of 2017. Therefore, it implies that you need to go back to the earliest period in 2015 when you had item of goods purchased into store and you start to use the new method as if that method is what has been used in the past. And this will more or less require necessary adjustments, all because the new method may not have the same amount, being the kind amount of inventory as at the reporting date, which then implies that an adjustment may be required for 2015, 2016. And in that situation, the cumulative effect of the adjustment is expected to be reflected in the earliest dates, which means in this case as of January 2016. And also the necessary effect of 2016 will also be recorded and presented on the 1st January 2017, of which relevant section of the retained earnings or the reserve will need to be adjusted to reflect these changes. And that's all what we mean by retrospective application. And that's why the implication of what I've discussed so far is such that an entity applies a new method retrospectively to comparative information for prior periods as far back as it is considered practicable. Now, we need to note the following. The amount of the resulting adjustment relating to period before those presented in financial statement is made to the opening balance of each affected component of equity, mostly to retained earnings. Usually the adjustment is made to retained earnings. However, the adjustment will be made to other components of equity as it requires. Also, when we consider it impracticable to adjust as a result of retrospective application the earliest period of any historical summary in the financial statement, this should be made clear and the effects should be disclosed as it relates to the affected periods. Also, entities are required to present an additional statement of financial position as of the beginning of the preceding period when a new accounting policy is applied retrospectively, and the retrospective application has a material effect on the statement of financial position as at the beginning of the preceding accounting period. This is key to note. But again, we are aware of the fact that there are limitations to retrospective application. And the limitation borders on how practicable it is to apply the change. When retrospective application of a change in accounting policy is required by IFRS, such change is applied retrospectively except to the extent that it may be considered impracticable to determine either the period-specific effect or the cumulative effect of such change. And that's why the impracticability exemption applies both to voluntary changes in accounting policies and those that are considered mandatory changes, which require an adjustment that complies with the transition provisions. And again, when we say it is impracticable to determine a period-specific effect of changing an accounting policy, on our comparative information for 1 or more years. The new accounting policy is applied to the carrying amount of the assets or liabilities at the beginning of the earliest period for which retrospective application is considered practicable. Now, this may be the current period, which is rare. Corresponding adjustments are made to the opening balance of each of the affected component of equity for that period when necessary. And when a new policy is adopted retrospectively, it is expected that it is applied to comparative period as far back as it is practicable. And also, retrospective application to a prior period is not practicable unless it is practicable to determine the cumulative effects on the amount in both the opening and closing statement of financial position for that period. That is essential for us to note in the course of adjusting the financial statements to reflect a change in accounting policy. The tax effect of retrospective application is also to be considered in this video. Now, most of the adjustments made to the prior period comparative information may have tax consequences, both current tax consequences and future tax consequences, which means an adjustment in line with IAS 12 as it affects current and deferred taxes may be probable, which implies that such adjustment is required as of the reporting date. And the technical note here is if an adjustment is recognized against opening retained earnings, the tax effect should also be recognized against the opening retained earnings. And that represents the position of IAS 8. Okay, we also look at the disclosure requirements when it borders or it relates to changing an accounting policy. The following is required to be disclosed. Okay, if the initial application of IFRS has an effect on the current period or any prior period, or will have such an effect, except that it is impracticable to determine the amount of such adjustment, or may have an effect on the future period, it is necessary to disclose the following information. The first thing is to disclose the IFRS involved. Okay, we also disclose when appropriate and applicable that the change in accounting policy is made in accordance with the transition provision as demanded by the new standard, the nature of the change in accounting policy when it comes to voluntary changes, when applicable, a description of the transition provision, when applicable, transition provision that may or might have effect on future periods, and also for the current period and each prior period presented. To the extent that is practicable, you are required to disclose the amount of an adjustment that affect every line items within a financial statement, vis-a-vis those that affect the measure of your earnings per share. We also look at the amounts you are required to disclose as it relates to periods before those presented and to the extent that they are considered practicable. And also, you need to observe that if retrospective application is impracticable for a particular period or for periods before those presented, the circumstances that led to this existence of such condition and a brief description of how and from when the change in account policy has been applied should be presented within the financial statement as a form of disclosure. This is very essential for our understanding of a requirement of IS 8. All what we have discussed so far borders extremely on application, or what I call practical application of IS 8 with respect to formulation of accounting policies and changes in accounting policies. Now we'll move on to the next um, practical situation or scenario, which borders on changes in accounting estimates. As we said earlier, accounting estimate depicts a measure of value in a financial statement. Measurement bases are usually based on estimates, okay? Because our base of accounting today is much more accrual basis rather than cash basis. And therefore, accrual basis more or less give room for making estimates of value in order to allow completeness of financial statements, even when the actual information may not have been obtained as at the reporting date. Now, we move on to understand that changes in accounting estimates is more or less considered as an adjustment to the kind amount of assets and liabilities for a particular period as it attributed to changes in methodology arising from changes in circumstances. Now, we'll start by identifying what constitutes an accounting estimate and also look at various examples of how estimate is made within the financial statements. Now, accounting estimates arise mainly from uncertainties surrounding businesses and its activities, which means that many items within the financial statement cannot be measured with precision, cannot be measured with level of accuracy until such information that present the actual figure is presented to us. For example, you make use of utilities and water bill has not been presented to you. You need to make an estimate. And the estimate is as a result of the uncertainty of the amount that will likely be billed thereafter. But your past experience, your current circumstances, and probably your future expectation will be a reliable source of making a valid, a reliable, a best estimate. And therefore, these are things we are going to consider in this video. Estimates are formed using judgment based on your past experience, historical data, your current circumstances and situation, and probably your future expectation. We are presented with common examples of areas that could require an estimate in the course of presenting a financial statement. The first one is allowable or bad debt, or what people term provision for doubtful debt. You have to make estimate of debt that you can consider irrecoverable, but you are not certain of the amount, the degree, the magnitude. But experience in the past may be the best way of making such estimates. Also, making allowance for obsolescence, write-off of the value of an inventory adds some degree of uncertainty to the actual amount of loss that may be experienced over time. Also, making estimate borders on fair value measurements of assets and liabilities, especially when it comes to measuring financial assets and financial liabilities within the financial statements. Also, useful life of an asset is being estimated. No one with degree of certainty can specifically say an asset will last for 4 years. It may be it lasts beyond 4 years. It also may be it lasts below 4 years. It's also possible that it lasts exactly 4 years. But no one with degree of certainty can picture a useful life of an asset. But based on experience, we can determine to reliably estimate what is the useful life. Also, when it comes to warranty obligations, okay, when companies sells products, experience will also show the level of defects that may be experienced on the sale of the products. And in that situation, it is expected that since there is an established liability or obligation which arose from the fact that it is more or less constructive obligation to the entity that when there is a defect, it is much likely, other than not, that repairs will be borne by the entity, or probably replacements will have to be made by the entity. In that situation, experience of such past replacement or repairs will be a basis to which warranty obligation can be estimated. Now, it is worthy of note that the use of reasonable estimates is essential in the preparation of financial statements, and a revision of an estimate may be required if the circumstances on which the estimate was based has changed. And that's why we say that if your basis of measurement changes as a result of the fact that circumstances has changed, such changes will be treated as a change in accounting estimates. Okay, the revision of an accounting estimate does not relate to prior periods and is not equivalent to the issue that borders on correction of errors. Errors has not been made because making a judgment cannot be termed to culminate into an error when such judgment need to be revisited as a result of obtaining additional information or of which circumstances has changed. Now, it should be noted that a change in the measurement basis that is applied to an item in the financial statement may constitute a change in accounting policy and not a change in accounting estimate, except if the circumstances has changed. In circumstances where it is difficult to distinguish emphatically whether a change in measurement basis is attributed to a change in accounting policy or either attributed to a change in accounting estimates, the change will be treated as if it is a change in accounting estimate, which means the preference of the standard is that in a real world where it might be difficult to explicitly distinguish between a change in accounting policy and a change in accounting estimate, the standard preference is to treat such situation as a change in accounting estimates. But a note of warning here. Mere in conclusion, or a situation where you as an individual, based on the fact that you are not able to expressly attribute a change in measurement basis to a change in accounting estimate or a change in accounting policy, does not qualify you to more or less exploit the provision of standard to say, since I cannot, therefore I will treat it as a change in accounting estimate. You might be wrong because the fact might be clear that shows that this is actually a change in accounting policy, especially for students. Therefore, it will be considered that when you are in the examination, or it will be very clear to you that you should be able to distinguish between an accounting policy changes and an accounting estimate changes. Okay, don't more or less conclude that since you cannot distinguish, therefore it must be a change in accounting estimates. Also, we need to understand the recognition basis for a change in accounting estimates. When there's a change in accounting estimates, what you need to do is to retrospectively apply the change. Sorry, I mean you prospectively apply the change, and that's what we call prospective application. Prospective application entails adjusting for the difference in the kind amount of assets and liabilities in the current period when sufficient information or when the circumstances was observed to have changed, and which means the effect of such changes affect the current period. And in some situations, it could also affect the future periods. For example, a situation where the initial useful life of an asset is put at 4 years, and 2 years down the line, the circumstances changes such that the pattern of usage of the asset change, and the asset is deemed to have an extended life of 3 years rather than the remaining life of 2 years, which then implies that the carrying amount at the end of the second year will have to be depreciated over another 3 years rather than the remaining period of 2 years, which impliedly will affect the measurement of the kind amount of that asset for year 3, year 4, and the extended life year 5, and which invariably it will affect the measure of financial performance in year 3, year 4, and year 5 based on the extended period of use and depreciation. And therefore, we can say that the effect of a change in an accounting estimate is recognized prospectively by including the effect or the impact in the profit or loss. And the effect will be included in the profit or loss in the period when the change occurred. And also, it may go beyond the current period. It might also affect the future period, like in the case of depreciation of an asset that we discussed earlier. Now, let's look at a practical illustration that borders on change in accounting policy. A change in accounting estimates. Now, should a change in estimate of an outcome of a pending lawsuit be recognized in profit or loss in the year of change? That is, you've had a lawsuit that has been running for 2-3 years, and as at last year, you estimated that it is probable that you'll be liable to the tune of 1 million naira. And this year, new information as reviewed by your legal team shows that the chance of being liable is now remote, and of which, even where you are liable, the amount of damages to be awarded may not be more than 400,000 naira. Therefore, the question then is, should a change in such outcome be recognized in profit or loss in the year in which your legal team so advises? And the suggested solution here include the following. It is likely that the change in the estimate would have been charged to the profit or loss for that period, even though the original estimate of the outcome may have been made several years ago, like in the case I've mentioned. and the case may continue for a number of years into the future. A change in an estimate of the outcome should be recognized in the profit or loss in that year, which means it is expected that on a continuous basis, estimate of value in the financial statement is required to be reviewed on a continuous or at least on a yearly basis so as to reflect not just only the historical experience or data, but it's also reflecting current situations and circumstances vis-a-vis future expectation. Now, the disclosure requirements include the following. An entity is required to disclose the nature and the amount of a change attributed to a change in estimate that may have effect in the current period and also in the future period. This is most essential for changes that are deemed material, and the disclosure of the effect of future periods is not necessarily required when it is impracticable to do so because of the cost benefits of financial reporting. In conclusion, if the amount of the effect in the future periods is not disclosed, probably because estimating it might become impracticable or indeterminable. Therefore, the entity will be required to disclose such facts on why such effects may not be quantifiable. And this more or less simplified the accounting requirement and of the effects of changes in accounting estimates. Okay, as we also move on, we'll look at the last phase of this standard. It borders on correction of errors. Now, the errors we are talking about here include what? Material errors, and secondly, prior period errors, which means we are talking about prior period errors that are deemed material to the financial statement of an entity. The financial statements of an entity do not comply with IFRS if they contain either material or immaterial errors, especially made intentionally in order to achieve a particular objective with respect to the company's financial position, financial performance, or of the company's cash flows. Therefore, errors can occur in respect of recognition, measurement, presentation, and equally with respect to disclosure of elements of financial statements, which means disclosure that borders on the assets, the liabilities, the equity, items of income, and expenses. Okay, but it's worthy of note that errors are distinguished from changes in accounting estimates because accounting estimates, by their very nature, are items that may not need to be revised as additional information. That may need to be revised if additional information is obtained in the current period, which means it is not time to be that you have committed an error because you have to change your earlier position. Rather, you are changing your earlier position or because you are obtaining a new information that tends to present the current state of the element of financial statements. Although, in principle, distinguishing between when error has been committed and when there is a change in accounting estimates may be vague, which means may not be clear. It is more or less considered from the angle of the standard IS8 that it will be more likely that this is considered a change in accounting estimates, which means it is much more evident when error is made rather than when there's a change in accounting estimate, which implies that when such indecision exists in practice and there is a close tie between is this attributable to error or attributable to a change in an accounting policy, the standards more prefer the treatment to be in accordance with the change in accounting estimates. Now, a practical example of this is a situation where you get a reverse tax assessment. And when you look at it critically, tax assessment is based on the law. And most times, the law creates a vacuum or what we call a lacuna, a gap, which is subjected to interpretation of who is who and from which perspective are you talking about. If you are more or less from the perspective of the taxpayer, the judgment or interpretation will be skewed towards favoring you for minimizing your tax burden. Whereas if you are a tax authority, you will be much more favorably disposed to enhancing your tax revenue, and therefore bias may warrant you to more or less interpret it in a way such that revenue is raised. Now, the issue now is from the angle of the taxpayer and entity. When an additional assessment is raised, it could either be as a result of judgment that requires changes, especially when it comes to interpretation, but also in extreme situation, it might be a clear attribution to a fundamental error that has been made in its application. Probably you are expected to add back depreciation to an accounting profit in obtaining your adjusted profit or what we call the accessible profit, but rather in your accounting for taxes, you erroneously deducted depreciation, and that warranted the difference in the assessment. Therefore, for those additional assessments that may have arise from interpretation or judgment from the angle of the taxpayer, it should be strictly considered that such change is a change in accounting estimates. Rather, the second scenario where you misapplied the law or probably you wrongly deducted depreciation when you ought to add back, such is strictly considered to be an error. Okay, which means we need to look at it thoughtfully to be able to distinguish between errors and changes in accounting estimates. But where it is impracticable to do so, especially when it comes to tax additional assessment, a conclusion might be reached in line with the standard to favor the treatment that borders on changes in accounting estimates. But again, if it is error, therefore we need to correct for the error. Now, the error we are emphasizing here are prior period errors, which requires correction not just in the current period, but in the period to which the error relates. And the essence of that is that you retrospectively restate the financial statement by adjusting the financial statement of prior period as if the error never occurred. And which means, in simple terms, we need to go back to the period to which that error was made, provided that error is material. If it's not material, it does not mean you don't correct for the error. But what it implies is that such correction may not be necessary to be retrospectively corrected if it's not material to the financial statement. Rather, it may be corrected in the current period. Whereas for material errors, it is paramount that such correction should be retrospectively applied, and every line within the financial statements in the prior periods to which the error relates should be restated in accordance with the principle of IS 8. And that is what we are discussing here. But again, situations might exist, like we find out in the earlier session that borders on accounting policies, where it might be impracticable to do so by retrospectively applying the correction and restating the financial statements. But what is very key is that you do so as far as it is practicable. Okay, but it is much more practicable to correct for errors than to adjust for changes in accounting policies. Because once error is attributable to a particular period, I don't believe it could be much more difficult for us to retrospectively correct and restate the financial statement. But let's look at a situation where exception exists. Now, when it is impracticable to correct for the error, and the error we are talking about is material period error, you need to look at the following: that such impracticability must be disclosed, and which then implies that such correction can be prospectively applied, which means probably can be corrected in the current period. But the fact and circumstances surrounding such should be disclosed in the financial statements. But as I said earlier, it is arguable to say that you may not be able to correct for prior period error, especially for the immediate prior periods. Now, going forward, except when it is impracticable to do so, material prior period errors are expected to be corrected by restating the comparative amounts of the line items of the prior period financial statements in which the error affects. And also, if the error occurred before the earliest period presented in financial statements, at least in principle and in practice, there will be three balance sheets or three statements of financial position that will be required to be presented, which include the earliest period balance sheet, the comparative period balance sheet, and the reporting period balance sheet. Now, in practical terms, what we are saying here is if error is committed in 2015 financial statements and it was not discovered, and we are in 2016 and we are to present financial statement of 2016, what we are required to do is to go back in 2015 to correct for the errors and restate the financial statement for 2015, so that as we present financial statement of 2016, the comparative of 2015 in the current period will have been the restated amount that has corrected for the error, as if that error never occurred in the first place. But what if the error was committed sometime in 2014, or probably years prior to 2014, and this error was observed in 2016, and we are in the process of presenting 2016 financial statements? What then do? We still go back as far back as 2014 or thereafter to correct for the errors, and after correcting for the errors, every line item has to be restated. And because this error occurred prior to the beginning period of the comparative period of that financial statement, which means it occurred before 1st of January 2015, which is the beginning period of the comparative year to which we present 2016 financial statements. Therefore, it is required and necessary that a cumulative effect of the error and the stated position should be reflected in the balance sheet of the entity as at 31st of December 2014, which implies that that is the balance sheet we open with as of 1st of January 2015, which implies that we show the balance sheet as at 1st of January 2015, which is the equivalent of the corrected version of the balance sheet as at 31st December 2014. We show the balance sheet which shows the cumulative and restated position as at 31st December 2015, which represents the second balance sheet, and the balance sheet that reflected the current status of the entity, which is the third balance sheet issued as at or presented as at 31st December 2016. And that's what we are saying in that situation. The technical note we need to take into consideration include the following. The correction of prior period error is excluded from profit or loss in the period of discovery, which means we are not expected to correct for the cumulative effect in the current period, but rather we are to retrospectively correct for it in the period to which the error relates. Okay, such that the activities you report in the current period are only a reflection of the current year transaction events and other conditions. Also, IAS 8 does not differentiate between fundamental errors and other material prior period errors. Rather, the IASB concluded that the definition of fundamental errors in the previous version of the standard will equally be adopted and constantly be applied to this current situation. Furthermore, IAS 8 refers to the correction of material prior period errors by retrospective restatements, but does not state that only material errors may be corrected in that way. But it is silent on the correction of immaterial errors, which is consistent with the fact that IFRS does not apply to immaterial items as contained in the conceptual framework. Nevertheless, explicit reference to material item in IAS 8 suggests that only material errors should be corrected in the way prescribed earlier in all what I've discussed earlier. This is the way in which the requirement is normally interpreted in practice, and that's the way we apply it over time. Okay, but that doesn't necessarily mean there is no need to adjust for immaterial error retrospectively. But again, it's a judgment put to management to look at the cost effects and the demand for going back to restate such financial statements. Okay, but in my own view, it may not be necessary to carry out a retrospective restatement of such immaterial errors in our prior period financial statements. Now, other key considerations regarding the statement of financial statements as it relates to correction of prior period errors include the following. Now, a prior period error is corrected by a retrospective restatement except to the extent that it is impracticable to determine either the period specific effect or the cumulative effects. Also, if it is impracticable to determine the period specific effect of an error on a comparative information for one or more prior periods presented, therefore the opening balances of assets, liabilities, and equity are restated for the earliest period for which it is practicable to do so. And this may be the current period, but it is rare. Okay? And also, if it is impracticable to determine the cumulative effects of all prior periods so affected by the error, as at the beginning of the current period, the comparative information is restated to correct the error prospectively from the earliest date practicable. The entity then disregards a portion of the cumulative restatement of assets, liabilities, and equities arising from the date. Also, any information presented about prior period, including any historical summary of the financial data, is restated as far back as it is practicable. Now, what we are trying to say here is a situation where CAMA require us to present 5-year historical financial data, and it then implies that if the error occurred in 2013 and we are presenting financial statement of 2016, and the correction has since been made. In disclosing our 5-year financial summary, we are to disclose information about 2012, 2013, 14, 15, and 16. It then implies that 2012 has no problem, but the error occurred in 2013. By retrospective application and statement, 2013 financials and figure will have been corrected and restated up to 2015. Okay, and in that situation, our disclosure for 5-year financial summary should also reflect such restatements in order to be consistent with the requirement of IFRS. Okay, and in conclusion, relevant disclosure that is to be made in the financial statements include the following as it relates to correction of prior period errors. When a material prior period error is corrected in accordance with IS 8, the following are necessary to be disclosed. 1. You are to disclose the nature of the prior period error or errors and the circumstances that surround such errors and the fact that such errors have since been corrected. And also, for each period presented, to the extent practicable, the amount of the correction for each line item within a financial statement is required to be disclosed with relevant details, vis-a-vis the impact of such correction on the amount of earnings per share, both diluted and basic earnings per share. Also, the amount of correction at the beginning of the earliest period presented must be disclosed with the breakdown of the details that's accumulated to the amount. Also, if retrospective restatement is impracticable for a particular prior period, the circumstances that led to the existence of that condition and a description of how and from when the error has been corrected should equally be disclosed. Now, we need to note that financial statement of subsequent period need not to report this disclosure because it may not be necessary to do so. The requirement for such disclosure is paramount as at the year in which such correction was observed and of which retrospective restatement was carried out. Likewise, entity are required to present an additional statement of financial position, which I've earlier discussed, as at the beginning of the preceding period when an error is corrected by retrospective statement and the retrospective statement has a material effect on the statement of financial position as of the beginning of that comparative period. Okay, as we have said earlier, in simple terms, we can discuss about what can be considered impracticable. Okay, impracticability in respect of retrospective application and retrospective statements can be observed from the following. Now, what is the meaning of impracticable? Now, how is it defined within the standard? Applying a requirement is impracticable when the entity cannot apply it after making a reasonable effort to do so. For a particular period, it is impracticable to apply a change in accounting policy retrospectively or to make a retrospective restatement to correct an error if the following condition exists. 1. The effect of retrospective application or retrospective restatement are not determinable. The retrospective application or restatements require assumptions about what management intended will have been or intention will have been as of that period, or when the retrospective application or statement requires significant estimate of an amount and it's impossible to distinguish objectively such information from those that may have provided evidence of circumstances that existed on that date or would have been available when the financial statement for the prior periods were authorized for issue from other information. Also, it may be impracticable to adjust comparative information for one or more prior periods to achieve comparability with the current period. And in that situation, this may be the case because data was not collected in the prior periods that would have assisted us to carrying out the retrospective application and retrospective statement. Okay, in technical notes here, which is more or less about historical information relevant to understanding the requirement of IS 8. Restatement is not impracticable just because of the cost or the effort involved. We need to take note of that because it may still seem to be material item which require a full-scale retrospective application. When IS 8 was revised in 2003, the International Accounting Standard Board considered replacing the exemption from retrospective application or a statement on the basis of impracticability with one based on undue cost or effort. However, based on comments received by the exposure draft commentaries, the ISB decided that an exemption based on management assessment of undue cost or effort was too subjective and may become ambiguous in applying consistently by different entities. And the ISB decided that balancing cost and benefit was a task for the board when they set accounting requirements rather than for entities when they apply those requirements. Therefore, although the standard does not explicitly say that the undue cost or effort alone does not render a statement impracticable, this is a clear intention of the board and is consistent with the definition within the standard, which means a mere cost benefit analysis or undue cost or effort is not just the factor that need to be considered. Holistic factor of how available the data and all other considerations are to be taken into consideration at every point in time. Also, on the estimate, it is often necessary to make estimates in applying an accounting policy to elements of the financial statement that are recognized or disclosed with respect to transactions, events, and other conditions. Now, estimation is inherently subjective, and estimates may be developed after the reporting date. But one thing you need to know is that developing estimate is potentially more difficult when retrospectively applying an accounting policy or making a retrospective statement towards correction of a prior period error. All because the longer period of time that may have passed since the affected transaction or event may have occurred. And in that situation, the objective of estimate relating to prior periods remain the same as for estimate made in the current period. And in that situation, for the estimate to reflect circumstances that existed when the transaction or other events and conditions may have existed. This is a consideration that we need to more or less put to practice. Nevertheless, IAS 8 notes that the fact that signified estimates are frequently required when amending comparative information presented for prior periods does not prevent reliable adjustments or correction of comparative information. Also, in making estimates, in correcting for errors, in accounting for changes in accounting policies, there is a benefit of use of hindsight. Okay, hindsight should not be used when applying a new accounting policy to or correcting an amount for a prior period error, either in making assumptions about what management intention would have been in a prior period or estimating that amount recognized, measured, or disclosed in that period. And that's why IAS 8 has cited some examples of an entity calculation of liabilities for employee accumulated sick leave in accordance with IAS 19. And when correcting a prior period error in relation to this calculation, the entity disregards information about an unusual severe influenza season during the next period that became available after the financial statements for the prior periods were authorized for issue. which means in assessing the basis of estimates towards the correction of errors or adjusting for accounting policy changes. The use of hindsight is not acceptable nor permitted based on the requirement of IFRS. On this premise, we will be bringing this lecture to an end, and I believe that you will have gained one or two things in practical terms towards applying the requirement of IS8. Okay, and where you have questions, comments, suggestions, do not hesitate to give me feedback on this video via the medium to which you have accessed the video, which include YouTube, my platform, which is Filmponomics, which can be accessed through www.filmponomics.org. Filmponomics is a platform through green finance concepts where we discuss finance, politics, and economics. Okay, and you can access that online real time. Thank you very much, and God bless.